With me right now is Gerard Lyons, chief economist at Standard Chartered. And Gerard, you were telling me that your panel is coming up this afternoon and the focus will be on the Eurozone. Do you think that the Eurozone will be intact in 5 years from now?
No, the euro can't survive in its current format. Basically, the euro is fundamentally flawed. The underlying economics are not sound. Good economics is good politics. Good politics is not always good economics, and unfortunately, politics has driven the euro process. Chancellor Merkel will be here in Davos this afternoon trying to put up a good story about why the correct action is being taken. But the reality is that European politicians and policymakers have acted too slowly. They've not done the right thing, and indeed, their policy diagnosis and their policy suggestions are making the situation even worse.
But is that fair to say that for countries across the Eurozone? I was just speaking to Michael Spence, and he was saying, look, if the situation in Italy, with Mario Monti taking the helm, it's, you know, and you see that as well in political circles. He's very much been invited in with Angela Merkel and Nicolas Sarkozy, hasn't it? There does seem to be some sense that his reforms in that country are making some headway. Yeah,
Mr. Monti's doing a good job in terms of trying to achieve the targets he's been set. But the reality of the situation is that there's austerity and there's recession in Italy. It's not only going to be a recession this year, it's likely to be a recession next year. And the real crux of the problem is that the euro encourages imbalances. In the good times, it encouraged hot money to go from Germany and elsewhere to Ireland, Spain, feeding property booms, feeding bubbles in their economies. That money suddenly went back home in the bad times, and those economies are now having to pick up the pieces. And those economies are just uncompetitive. So what we have is really a two-speed euro. The core of Europe in good shape, the periphery, Greece, Spain, Italy, Portugal, Ireland, facing recession for some time to come. Youth unemployment in Spain, for instance, is 43–45%. I don't think these economies can really sustain the economic pain for too long. So again, it comes back to the political issue that you just touched on.
Do you think that German Chancellor Angela Merkel, or indeed the ECB, will step in and take action that is perhaps more substantial than what they have done so far to prevent any breakup of the Eurozone, to prevent that worst-case scenario from actually materialising?
Well, partly because the politicians have been so slow. Anything that they do on the positive side is now greeted positively or greeted well. If we think back to September at the IMF meetings, it was talked about that the EFSF, this bailout fund, was going to be maybe 1 or 2 trillion euros in size. Today, this morning, we hear the Germans may add money to make it 750 billion euros in size, so i.e. much smaller than people were hoping for only 3 or 4 months ago. But because things have been so bad in the intervening time, people think at least it's a step in the right direction. But in terms of where are the sort of shock absorbers, there's a good shock absorber and there's a bad shock absorber in Europe. The bad shock absorber is unemployment, particularly on the periphery. That's why the situation in Spain, Italy is really very key. And the good shock absorber, coming back to your question, is the European Central Bank. They are doing the right thing. They're adding liquidity. They're allowing banks to actually access their funding. And they're actually doing enough to sort of buy time. But biding time, while it's helpful, doesn't solve the underlying crisis.
What do you think how would the banks be affected? What would the fallout be on the financial system if we were to see a messy, disorderly default for Greece?
Yeah, the likelihood is that these things take a long time to sort of work their way through the system. I think the system can cope with Greece defaulting. I think the system can actually cope with Greece leaving the euro. And I think both are likely. Difficult to say exactly when, but I would guess over the next 18 months. Initially, the default within the euro, and eventually I think they will throw the towel in because the economic pain is too much. And then the big issue for me is whether there's enough of a firewall to prevent the problems going to other countries. And initially that firewall will probably be good enough, but if we have still 2 or 3 more years of recession, then that firewall will not be big enough.
But there has been some sense of optimism with German Chancellor Angela Merkel and others talking about this immediate move, this transfer to the European Stability Mechanism. Its capital structure is different from the EFSF, and then the proposal by the IMF to boost their firepower, their war chest as well. Does this fill you with some confidence, if any?
Well, they should have been doing this 6, 9, 12 months ago, and they should have been doing it in bigger size. So again, it's good that they are doing this, but it's like shutting the garden door after the horse has bolted, so to speak, i.e. they're doing it too late. It is enough, maybe for some people, but I think when you look at the economics, they probably should have done a lot more. So at least it's a step in the right direction. But stepping back from Europe, it's not the only issue here in Davos. What we have is a very much a divided world economy. The emerging economies are in good shape. That comes out of all the sessions so far. America is growing, but at an unspectacular pace, maybe 2%. But the problem area really is the periphery of Europe. So a divided world economy and also a disconnected world economy. And last night, one of the big debates was about what the corporate as well as the political side could do to stop unemployment rising and to address the income disparity.
Gerard, if we could just switch attention now from Davos to the world's largest economy, the US, and we were speaking a little bit about whether or not this optimism, because the data has actually been pretty healthy, if you look at what's been coming out of the US over the past few months. Is the recent optimism on the outlook for the US somewhat premature? Where do you stand on that?
Well, thankfully at Standard Chartered, we've read the US really well in the last 6 months. And the reason for mentioning that is that 6 months ago, the competition, the market was very pessimistic about the US. And what we're seeing is the market trying to catch up with reality. In some respects, it's like a pendulum. It's gone one extreme 6 months ago being too pessimistic and maybe the other extreme now becoming too optimistic. And the reality is somewhere in the middle. The US economy is growing. That's the really good news. It's growing at a steady pace, maybe 2%. And compared to Europe, that's a considerable improvement. The big question is whether confidence is going to be good enough in America to encourage big firms to go out and invest. The thing about America, and in some respects about Europe, is that big firms are in good shape. Balance sheets are fine. Normally, at this stage of a recovery in America, those big firms would decide to invest. If they decide to invest, then America goes from generating maybe 200,000 jobs a month as now to generating the 400,000 or 500,000 jobs a month it needs to really start getting to strong growth. So if big firms have that pickup in confidence, then that suddenly moves America from 2% growth next year or this year to the 3, 4, maybe even 5%. And so it's all about confidence. But when you look at the US, the outcome depends on the fundamentals, policy and confidence. The fundamentals are mixed, the policy cupboard is bare, and confidence, therefore, is the key issue to focus on.
Let's talk a little bit about emerging markets, because we were just talking about the World Bank cutting its forecast by the most in 3 years, but specifically issuing a warning that these markets were particularly vulnerable to the euro debt crisis. So what can countries like Brazil, China, India do to defend themselves?
Well, I think the IMF is catching up with reality. Many of these emerging markets have been tightening policy for much of the last year. In fact, this time a year ago, inflation was the big worry for the likes of Brazil, India, China. So then they were tightening policy. That tightening of policy started to feed through. On top of that, the euro crisis hit. So these economies are now cooling down. But the key difference between those economies and the economies in the West is they've got plenty of room for policy manoeuvre. The likes of China and India, Brazil, they can all ease policy quite significantly, cutting interest rates, boosting government spending. So even though there will be a slowdown in the next few months, and even though the economies across the emerging world are not decoupled, not immune to the problems in Europe, they're in much better shape, much better able to cope.
So they've got more tools in their policy cupboard.
Absolutely.
Compared to what we've seen in the West. And so if we look at China for a minute, inflation has been falling back. Is there scope for more monetary and economic stimulus in that country? Yeah,
well, I've just got back from 2 weeks in Asia, and the mood out there is so different to here in the West. But the reality is that they are slowing down. In China, yes. China's been trying to squeeze inflation, particularly in the property sector. And I think they've done that quite well. A couple of weeks ago, there was data showing that in Beijing, the big market, property prices had fallen over 11% last year. Speculators were being squeezed out of the market. First-time buyers were coming back in. All the things the authorities wanted. I don't think they want to ease too aggressively too soon. But if the economy does start to slow, then I think they will start to take the sort of break off and start to actually allow interest rates to come down. Of course, on top of that, remember, the Chinese keep talking about their 12 to 5 year plan.
Yeah.
Amazing to think 5 years ahead. Here in Europe, people aren't sure what's going to happen 5 months ahead to the euro. But in China, they've got a long, drawn-out policy, and it's about boosting the economy, moving it up the value curve. So slowing down in China, but a still underlying resilient economy and confidence holding in quite well. They're not fully decoupled yet, are they? Which means that they're still perhaps... I mean, would you say they're more vulnerable now if we were to have another shock, say, a default in the Eurozone situation, and then if there was a knock-on effect in financial markets, would you say emerging countries are more vulnerable now than they were in 2008? Probably not. In 2008, they were hit hard. They were hit hard by trade finance, by bank lending being withdrawn from their markets, and by the hit to confidence. This time around, I think they've got more scope and more policy room for manoeuvre. But on top of that, there's been a big difference in the last few years, and that's the fact that domestic demand in these economies is stronger, and we're seeing more trade between emerging economies, between one emerging economy and another, between Brazil, Africa, between China, Middle East, China, Africa, China, Asia, you name it, across the emerging world, and we've seen trade flows pick up. So that makes them not immune, but more resilient. Of course, at some stage, China will have a setback. The business cycle does exist in China, but the trend is up.
And when you speak about domestic demand, what are we seeing in China right now? Because we know that those huge disparities in income still exist. Social security system isn't in place, or it isn't strong enough to allow people to be comfortable enough to spend their incomes. Is that now starting to change? Will domestic demand be strong enough to withstand a slowdown in exports?
Yes. Well, it depends on the jobs being there. So I think the answer is yes. Of course, China is more than one economy. There's many different parts to China, some of them doing better than others. But one of the key things is that in China, they are actually seeing a big fundamental shift in terms of how the economy is operating. Chinese wages are rising, maybe too much in some people's minds. Property sector has cooled, as we talked about. But I think there's a lot more confidence. China has all the issues that we have in Europe. Big problem in Europe is that the economic cake is not getting bigger, hence there's the problems. In China, the income disparities are large, but the economic cake is getting bigger and bigger.
Good stuff. Gerard Lyons, Chief Economist, Standard Chartered, thank you very much for joining us.
Yeah, pleasure.
On this special edition of The Pulse. Really interesting to get your thoughts, the outlook for emerging markets and for the Eurozone. I know that you have a panel a little bit later on today, but thank you very much for sharing your thoughts and analysis ahead of that.
Pleasure.